I was just going through some of the details with regards to the Monetary Policy Committee decision that came through. No surprise that no movement was made on the interest rate front.
Yeah, I mean, I think market players' expectations going into the meeting were homogeneous. I think a lot of the market players expected that the central bank rate will be held constant. And the reason for that is that it's only now that we're starting to see, a sort of improvement on the item sets that inform monetary policy. So we're seeing inflation moderating at around 18%. It came down this month. We're also seeing the exchange rate being stable for most of the month and actually showing a 1.8% gain over the US dollar for the month of January. And we're also seeing second round effects of inflation being curtailed. We've not really had anything about threats of industrial action or strikes going forward. So the logical thing would be to hold the central bank rate constant and wait and see for effects going forward on the price level and the exchange rate.
Well, the truth of the matter is that when you have interest rates to this extent, private sector credit growth has been slowing, and it has been something that the MPC has been discussing as well. With a credit scenario that is looking relatively bleak, one does hope that inflation is going to hit very close to the single-digit level. What kind of expectations are there in the market at this point?
Well, as far as inflation, I mean, you just hit the nail on the head when you say inflation rates are going to dictate where interest rates are going to be at, probably within a 10 to 12 month outlook. As far as inflation rates are concerned, heading into the second half of the year, we did see a sort of cautionary note, whereas the central bank highlighted the fact that they are expected to be, probably not conducive weather conditions for agriculture. Now, with food, occupying about 36.4% of the CPI basket, that does give some sort of upside risk for food inflation going forward. And in the event that they decide to actually maintain their tightening stance, as would be expected, then the likelihood would be for interest rates to remain at elevated levels going forward.
Well, let's just touch on the banking sector, because we know that also the banking sector remaining relatively stable. The MPC has been alluding to this as well. How would you say that the earnings are going to play out going forward this year? Results are imminent, and we know that the banking sector has been one of those sectors that has been affected by this very high interest rate environment.
Yeah, that's a good question. I mean, our expectations for the banking sector particularly are for, below trend growth going forward. I think we've slashed a bit of our earnings focus for some of the mid-sized banks, and really that's because of the sort of adjustment that we're expecting as far as non-performing loans in their books. But I think at the same time, you really have to look at when the interest rates started, impacting earnings in terms of when actually the hike started to translate into their borrowing numbers. I think that was probably felt within the fourth quarter. We have seen a slowdown in credit, but it depends on the particular sectors. Whereas sectors like real estate, which have been robust, have seen, probably just a bit of a slowdown. But personal consumer borrowing has been hit probably the hardest. But I think, going forward, 2013, 2014, we expect bank earnings to bounce back on account of that.
So which would your plays then be within the banking sector, Evans?
Within the banking sector, I mean, with a 3-month outlook, we're really right now, expecting, firms that probably have a margin of dividend safety to perform well. I think the sort of names that we're looking at right now would be Kenya Commercial Bank and possibly Standard Chartered, though their performance is projecting forward is probably a bit shaky. For the mid-size level banks, we probably expect probably not much of a change in terms of the dividend strategies as well. So as far as those payout ratios are held constant, I think with a 3-month outlook, banking stocks expect to perform well.
It's no surprise that the shilling has been strengthening, in fact hitting a record level against the dollar. What is your sense with regards to the performance going forward? Of course, we know that a lot of the investors, foreigners, are looking for yield, and clearly Kenya is offering that.
Yeah, that's certainly accurate. I mean, if you look at the charts, what we're seeing right now is that probably 83.55 offers a bit of support. But going forward, I think right now it's split 50-50 with the central bank rate left unchanged. We'll probably see a bit more weakness, we could see weakness going to 85, or strength probably heading towards 82 shillings and 80 cents. But I think, for the outlook for the shilling, it should probably be stable at current levels as far as the central bank maintains a tightening stance.